Hi Dan, it's great to have you here today as part of our private capital series. Welcome.
Thanks very much for having me.
As you know, we're doing a series on private capital, and as part of that we are speaking to various different industry leaders and really interesting clients.
The business was founded by three of us in 2017, late 16, early 17, which was a culmination of a long career in real estate finance. And we originally set the business up to manage our own capital. So we got a principal investor's mindset, and we started to get approached by various friends and families that we knew to help generate yield for them. And now we look after money for about 300 different high net worth family offices, smaller wealth managers, and some larger wealth managers as well. And we do that all digitally and offering clients a very personal touch should they want it, or they can manage all of their deals with us via a digital platform, which has been a lot of work, but we think very rewarding, because what we're seeing more and more is young people want to do stuff online. They want to do it quickly. They want an app. And older people want to pick up the phone and have a very long chat, and we can offer both.
Yeah, so you're starting to touch on tailoring there, and that kind of links into what I was going to ask about your USP and how that particularly connects with the private wealth type or private capital clients. How do you deliver something different as a product to cater for that ecosystem of client?
I think first and foremost, as I said, we started as principal investors, so we don't originate product to distribute it. We originate product because we fundamentally believe it and we co-invest. So from a risk-reward perspective, you know that you're investing alongside the people that you're investing with, rather than buying a product that has been created for you. I think that's really important. Secondly, unlike all the debt funds out there, we offer a deal-by-deal platform where whoever you are, whatever your risk profile, you can log on and you can look at a variety of transactions that might offer you considerably safer returns in the high single digits up to the mid-teens, and you can choose where you feel most comfortable in that spectrum. And we're always trying to outperform the market and get the best risk-adjusted returns that we can. If you're the kind of investor who says, that's great, I love what you're doing, but I really don't have the time to read the very detailed prospectuses that we produce on every single transaction that we do, you could say to us, look, we like what you do, we'd like to allocate X amount of capital, and we'd like to make sure that we've got a nice spread of assets to which we're lending upon, and then we can create a segregated mandate for you. So we can be very bespoke, we can be line by line, deal by deal, or we can create your own mini kind of fund / segregated mandate. So, and we're kind of size agnostic. So if you want to invest with us in the hundreds of thousands, that's absolutely fine. We've got investors who are investing up to 50 million with us. So the range of clients we have is from maybe £250,000 up to 50 million and more. So in a lot of other businesses out there that cater to someone who's got £500,000 or £1 million to invest don't have the platform, the scale, the track record to deal with very large investors and vice versa. And I don't know if you know, but 2 years ago we sold half of the business to a PRA regulated bank, Oak North, because we offer a unique service to be able to blend a deposit-taking bank's money with you as a private client money, offering really interesting returns for you, the client, and then at the same time, it provides great opportunities for the borrowers to get structured packages that they can't get from banks or some of the bigger debt funds.
Yeah, and that's sort of like a whole world service for clients, isn't it? Because you just have mentioned with the dynamics of a debt fund is that we've got investors coming in one end, but also got borrowers approaching in the other, and being able, we feel part of our USP is being able to connect people's personal business worlds with that tailored personal approach that then builds trust. And so when you do have those clients who don't have time to spend a lot of time looking at something, but they really want to place funds with you to develop that trust relationship.
Yeah, and I think you're spot on, and also we're quite uniquely one sector focused. So I started doing this at 25 years old at Investec, and it's kind of all I've done till now, and I'm now 50, so it's 25 years of originating the same kind of transactions and showing consistently reliable returns. A lot of people got into the world of debt finance against real estate post the GFC in 2008, so when the banks started to pull back in 2009, 2010, lots of debt funds sprang up to to fill the gap that the banks had left behind. And the people running those funds might have come out of hedge funds, and they're very much return-based analysts, whereas we were doing this in the late 90s and really looking at the real estate and how do we match the finance to create that. So in some respects, although we're offering debt, structured debt products to our clients, we're also just as detailed in the real estate, and we feel that a lot of our competitors are much more focused on the numbers and the financial engineering, whereas we start with the bricks and mortar and how do we generate the right returns for our clients from those bricks.
And I think that's really important because the debt market, as you refer to as sort of post-credit crunch, it is very saturated in terms of choice of different lenders out there. And so actually it's really important to have that USP and also to do the right deals so that the track record is really consistent. And certainly from when we work with you, we know that, yes, there's the driver to get the deal done for the client, but there's also a very, the sophistication of knowing the property, of being able to digest the issues and really deal with them, rather than some of the more generic lenders who it's a computer says no approach, and that either doesn't work for borrowers or perhaps are missing some of the bigger issues. So from an investor's perspective, not great either.
You're spot on, but it's about size as well. So a lot of businesses that we compete with on the mid-market to larger size transactions, they are raised to deploy businesses. What they're very good at is raising capital from institutions and deploying it in the market, and dare I say, earning great fees to do that. Whereas that's never been our business model. We're trying to find the needle in a haystack that we think, wow, that offers us great risk-adjusted returns for our own capital, and if we're happy, then we will offer the opportunity for our investors to join us. We don't basically just raise money and get paid to deploy it. And the problem is with most of the larger debt funds, as you scale and you have more and more money under management, you invariably turn into that business model. There is no way to do it otherwise. So we've always tried to grow organically at a pace that allows us to be absolutely rigorous about credit and always maintain a principal mindset when lending money. And I think that's our USP, as well as our offering around the digital platform that we've created.
And you also mentioned earlier sort of the skin in the game aspect, that you're alongside your investors as well. It is a very different mindset when you're thinking, would I place, if the investor turns around and says, would you put your money in? You go, yes, and we are. That's very different, isn't it? And that really helps to build that trust for investors.
It really does. And also, I'd say of our stable investors, half of them have made their money in real estate. So we credit approve a transaction and then we send it to our investors, and then we've got another whole layer of dozens of super experienced real estate investors who might have owned the building that we're lending on previously, or might own the site next door. And if anyone spots anything that maybe we haven't, we'll get a phone call and we'll have a long chat about it, and we think, okay, maybe we've missed something. We go back, workshop it with the borrower. And there have been times when an investor of mine's phoned me up and said, Dan, I don't think you should be doing this deal. And as much as we might be at the 10th hour of a transaction and look at it and think, you know what, I'm going to phone the borrower and tell him he needs to put some more money in, or we need to restructure it, or we need to deal with an issue that someone spotted that we haven't.
Yeah, but it's so much better to deal with things head up rather than on, once transactions in course, and then, enforcement issues, and it's best to set expectations at the beginning as to what's going to happen rather than end up with a difficult loan on the books that, difficult relationships down the line.
You've mentioned the dreaded enforcement word, but on the existing book, I think because it's our own capital, and also we know personally a lot of investors, so there's a huge responsibility. And if things are not panning out exactly as they should, and no one's going to anyone who sits here and tells you they've got zero issues when they were lending money pre the Liz Truss budget and interest rates going from 0.1% to 5.25%, it just can't be. It just can't be true, right? Everyone's got issues, but what we try to do is really get ahead of that, have a business plan, have alternative exit routes, and protect our investors' capital early, rather than just hope things are going to get better, because invariably they get worse before they get better, and you need to be ahead of the curve.
You've touched on the difficult market that we've had in real estate for the last couple of years, and I think that is a really interesting point for private capital clients, because there is this real need and demand for people to place their money somewhere. They really want to invest and they have funds to deploy, And obviously people are always attracted by high demand and high return. So, what trends in the market are you seeing with private capital in your investors? What sort of assets are they really interested in at the moment?
So I'm a natural bear. I always think we're end of cycle until we've fallen off a cliff. So we were incredibly cautious in the run up to the change in interest rate environment. I wasn't a believer that QE goes unpunished. You can just keep printing free money and get away with it.
Yeah.
At some stage, you've got to pay for it.
Yeah.
And that's what's been happening for the last 24 months. So I think that because of that, real estate debt and real estate as an asset class has really suffered and is no longer flavour of the month. Mm-hmm. Conversely, that's exactly the time you want to start investing, because valuations have probably come off 35 to 40% from the peak. So if you're lending at 65% of a valuation that's 40% lower than it was 2 years ago, your attachment point on that asset is very attractive. And what we're seeing is good, solid real estate assets, but the cash flows don't work anymore because of the massive change in debt costs. So borrowers are coming to me and saying, I've got this fantastic asset, I've got debt from Lloyds, or I've got debt from Santander or Barclays, and if interest rates were 2%, this would be a perfect portfolio that they're desperate to lend on. Because interest rates are now 5%, I'm being asked to inject a large amount of capital across my portfolio that I don't have, because I've been tipping into service this for the last 2 years. They're good assets, can you help me restructure? So we're seeing a lot of restructuring opportunities where we inject fresh capital in what we perceive to be a safe part of the capital stack. Yeah. It helps the borrower reorganise their affairs, and we can get outlier returns against good, solid assets.
Yeah, and are you injecting that as mezzanine finance or equity? How do you what's the go-to for structuring?
So we tend to try and write the whole loan and then inject capital behind us so that we're controlling the situation and the debt stack. Yeah. We're not a massive fan of pure mezz, where you've got a bank with a pretty standard intercreditor and you're being asked to come in, solve a problem with very few rights. Yeah. The only way you get control is to buy out the senior. We prefer to say, look, we'll take everyone out now, we'll provide you the capital to restructure your affairs, and then we'll back leverage that to provide our private clients really interesting returns. Or we won't leverage it at all, because some of our more conservative clients say, look, we love what you do, but we prefer a lower return on our money, but just know that we're in charge of the asset and we're effectively first in line, so we don't want any debt in the structure. So, as I said, we work a lot with Oak North because obviously they're our partners, and they often put debt into our loans, which is good for them and good for our clients. But quite regularly as well, we're saying we don't want any debt in the structure because some of our investors just would prefer an unlevered situation.
And that's a really interesting USP that you can offer to your investors as well, to achieve that higher return. Take you up the risk profile, but actually when you're looking at assets, as you say, if we were talking about a standard economic climate, these assets are all good real estate assets. Exactly. The only thing that is changing is the flux of the inflation and how things are moving at the moment.
Absolutely. I mean, that drifts us into a more interesting conversation around what's happening on the 30th of October, what this government's done to date, because we're in a downward real estate curve in terms of interest rates. That's the view, right? Interest rates have come down 25 basis points, and there's this kind of feeling, and the yield curve is showing that we're going to have another 75 to 100 basis point cuts over the next year or so. If the government, and I'm in no way opining on whether they're right or wrong in this process, but if we keep agreeing to wage demands in the public sector, how is inflation actually not going to start to tick up? We have some concerns about stubborn inflation. So when we're underwriting, we're not getting carried away by a flattening or decreasing yield curve and thinking, look, if rates don't come down, does this still work? Because we're competing with a lot of other funders that are taking a view that, the worst is over, rates are going to come down, and that's going to have a massively positive effect on real estate values. Yeah. So we're always saying, does this make sense if that doesn't happen and values stay where they are today? Yeah. And we don't want to build in any blue sky thinking into our underwrite.
Completely, and I think it's not just looking at the next 6 months to a year ahead. It's looking, does this asset stack up for the longer term? And those are the assets that, even if there's a wobble, you're happy to hold in some way, whether that's through the borrower or through some sort of level of enforcement. And the other thing that I see you guys do a lot, and it again I think is a sign of the market, is sort of pre-development loans / development loans coming back in, which is really interesting because obviously there was a period of time where construction costs were escalating so much that developers were overstretched and so not sort of looking to bring in new sites. But when again we look at like where are the opportunities for higher rates of return, the changing use of land is an obvious one. And I see that you guys are in there sort of originating those types of loans at the moment.
Land is a really, really hot topic because when interest rates go up and costs go up, which they have done really aggressively post-COVID, values also get hit. You've got a perfect storm of everything that you don't want to happen as a landowner, right?
Yeah.
Because if the end product isn't going to sell for as much, if the cost to deliver it is higher, de facto the residual value of that land is going to get seriously impaired. And we've seen land values halve. There's no doubt about it. Even good central London sites have halved in value. It's just the geared effect of a residual land appraisal. And because of it, no one wants land. There's no income. You know, the house builders some are doing better than others, but there is some indigestion. And on top of all of that, the planning process has been horrendous, absolutely horrendous. You know, whatever you think about politics, our last government did not do much to improve the efficiency of the planning world. We've got a new government that's talking about improving that, and definitely the mood music around councils seems to be a bit more, we've actually got to get on and fix this problem now. And if you're looking for really interesting higher returns and you've got an appetite for a bit more risk, land is a very, very interesting part of the cycle.
Yep.
But, you know, as a business, we certainly don't want to put ourselves out there saying, you know, we fund land and that's our area of speciality, because clearly income producing assets provide the best security for investors at the moment.
Oh, completely. And also some of the development assets that are the most interesting actually is when it's a change of use. So you do have tenants and an investment profile already. It's just that there is a switch that maybe it's going to become resi or mixed use or offices going to something else. I mean, I think
we do a lot of that.
How we use property has changed significantly since the pandemic, because there's a huge amount of social change that's happened. And obviously the economic change that's happened has also then stifled some of the growth and productivity that could have resulted. But we are, I think, starting to see some of that coming back by developers being able to go out and invest in new sites. And as you said, this is about long-term real estate. That's about pipeline for development for the future, as opposed to something that's been delivered now. So it's really encouraging to see that sort of going ahead again.
Yeah, and I think that after COVID, the way that people want to live and work has changed. People want more flexibility. They want more community asset. And they want somewhere to live that they can afford, right? Which, quite frankly, they haven't had. I think that reopening and re-looking at PDs so that virtually any office that can be successfully converted to residential is a good policy, but it needs to be managed properly. Historically, it hasn't. Developers have found a way to take not very nice office buildings and turn them into not very nice residential flats. I think we can do better.
Yeah.
And we've got so much redundant real estate that actually what we really need as a country is better communication and a better working relation between public and private sectors for real estate. If this current government can actually work with the developers, listen to developers, find a way that the developers can actually solve the problem while earning a sensible living and being taxed reasonably, that's the nirvana, right? The problem is that developers are always trying to get the most out of a scheme that they can, and historically councils are always trying to fight that and stop them and get as much social and CIL and taxes as they possibly can. And there's this imbalance of push and pull, and really what councils and developers should be doing is saying, look, here's all this redundant property now. We've got all these offices that aren't fit for purpose. We've got all these town centre retail assets that aren't fit for purpose, and people need places to live all up and down the wealth scale. So that could be, successful young professionals, but it could be key workers. Why we can't deliver, a couple of hundred well-built modular or converted units near hospitals for nurses all up and down the country. It's not that hard to do. It's just there's no incentive for all the stakeholders to come together and do it. And as a business, we're really passionate in trying to provide capital into those areas where we can actually get return for our clients, but be a source for good as well.
No, I agree, and I think because different councils have different approaches as well, there's a lack of consistency. If it was very clear that all councils had the same approach, developers wouldn't be pushing because they'd know what they're going to get, and councils wouldn't feel that individuals could block a scheme or be particularly difficult. But also, I think there is also a need to drive forward different types of housing that are required, not just a sort of a focus on affordable, which is the current focus, because there are things like senior living and co-living and other things, buy to rent, rental properties being more available. Those types of residential are all really helpful at building a wide range of options for good quality housing for a dynamic population who have a variety of needs.
And I think that the build to rent and the kind of purpose-built, whether it's purpose-built student accommodation or assisted living for the elderly, it's a real shame because as those kind of asset classes started to develop from a nascent place in the UK, all of the valuations that attributed to those kind of assets were set up at a time when interest rates were trending at ridiculously low levels. And as BTR started to take a foothold in the UK, it was just before rates totally changed. So now we're in an unfortunate predicament where actually there's some really good BTR projects that are in good locations, could offer sensible housing for people. But in order to make the numbers work because of the cost of capital, everyone's having to push the rents to make the bottom line stack up. And the problem that's not helping people find somewhere to live at a price they can afford. So it's almost like we need to kind of rebase values. We need some kind of intervention from central government to help these projects get off the ground so that whatever they are, whether it's housing for the elderly, housing for young professionals, or affordable housing or key worker housing, the rents that people can pay are within the budget of affordability. And there's, post 2008, one of the effects of QE was that there was this affordability gap and many multiples of your salary was required to either rent, either to get on the housing ladder or to rent the kind of property you wanted to live in. There's a lot of government money that gets spent in housing. If that could get spent in a really commercial way, then I think we can fix the problem.
And if you had to say what's a sweet spot deal that comes across to your desk, what is that asset where you sort of go, ooh, it gives the excitement?
I think you touched on it a few minutes ago. If someone comes to us with an asset that's income producing, has got an existing use and has got a cash flow, obviously it's going to be a short-term cash flow because they're not going to come to us with a 10-year lease to Amazon. Something that's producing cash for 2 or 3 years where actually the underlying asset is stable, but they've got a business plan to add a lot of value, then we're covered by the core asset that we're lending on, and they're producing an extra buffer for us by adding more value to that site. It could be an office building that's well let on a big site where they can put another building or a distribution asset or even a residential block. We're not big fans of funding vanilla transactions where someone's just buying something in the hope that they've bought it well and the market's going to move with them and they're going to sell it. We really want someone to buy something well and have some magic dust to sprinkle over it to add value, because that value add creates a buffer between us and the valuation.
And I think what you're referring to is the modernisation of the real estate market. I think real estate in a stable economic climate can be something that anyone could invest in and make a return because of the way money and values are moving. But actually now you have to work hard to create that value, and it's great working with both investors and borrower companies that have that entrepreneurial ability to see how you can take something and change it into something else, and that value add creates something that no one else has been able to spot.
100%. You won't get capital appreciation by being a passive real estate investor. in the next cycle the way that we have in previous cycles. I just don't see it. There's too many factors that have got to be overcome in terms of tax, in terms of ESG, in terms of, you know, green credentials, in terms of the macro economy. You've got to create value by rolling up your sleeves. And we're only interested really in working with borrowers who want to do that.
Yeah. And we particularly like working with clients who like doing that too, because that's what the fund deals come from as well. So just taking back to the investor side for a moment, obviously the sort of private capital client more and more is a dynamic family or family platform with businesses, and they're transient. They are internationally spread. But are there any particular jurisdictions where you see your investor base coming from, or sort of different jurisdictions that you're particularly interested in growing investor relationships in the future?
Takes me back to the October the 30th conversation, right? So a lot of private capital that we're talking to at the moment is sitting on its hands, thinking about where it's going to structure itself, pending what happens, because there's a lot of political uncertainty globally.
Yeah.
And where we're fortunate in the UK, we've still got good rule of law-ish. We've got great time zone, great language advantages. And we've actually got a settled government with a big majority, and you know what's coming in terms of the political position. And if you look across France, Germany, Italy, parts of the Middle East, parts of it, there's very few places in the world where there is a clear direction of government strategy. But what we don't know is we've got a lot of anecdotal stuff flying around, but we don't actually know what's coming in terms of taxes for private capital and families. So I think it's early to say where our investors are going to come from.
I've recently come back from Singapore because I have a lot of clients out there, and was talking to investors in Singapore about, you know, what the appetite was to come back and put into the UK. And actually, the things that might happen on 30th of October, they can get their heads around those things. It's actually the period of not knowing what they are, because it's just a level of certainty that's required, because you do, as you say, you have to compare it to the global risk of different areas and different jurisdictions. And again, the UK is seen as a strong place to live and to work. The sooner we can have some clarity on some of these things, I think the sooner we'll see a return of investors then being able to make decisions and also revisit some structuring and look at how they proceed. And also for the private capital client, it's not something that is changed every few years. They rethink where they're going to live. You're talking about someone's lifetime, and therefore, you know, families planning for many years, for decades. So you have a chance to get it right, and if you get it wrong, you know, it's a long time before you perhaps can correct that by getting the next generation to come back to the UK. 100%.
And look, I have to be honest, a lot of conversations we're having with our clients is, if people aren't moving, they're certainly thinking about a contingency plan. They are hedging the UK, so they want to be here. A lot of my clients have created wealth here, had a great life here, but they're not going to be here if they can't continue to do entrepreneurial things and take home some of the proceeds.
Yeah. So the challenge is for us to remain a climate for entrepreneurs.
Yeah, there's a lot for this government to sort out.
There is.
Yeah.
And just sort of going back to investors again, I understand that you have a variety of female investors, and I just wondered if there's sort of different trends that you see with female investors and the type of assets that they are interested or transactions they're interested in.
Our head of investor relations is a woman. There's been talk for so many years about the lack of females in the real estate industry, and I think as a house, as a business, that's something we feel really passionate about. So, you know, how do we get more women, when they finish university, to come and choose real estate as a asset class that they want to work in? And because most of our investors are part of a couple, or they might be women themselves, how do we encourage them to be part of the decision-making process? How do we encourage more of our investors to say, look, okay, so you really like what we do, but what does your wife think? Bring her along. Let's have a chat and understand the psyche of how families want to invest, rather than just the patriarch of the family, which feels kind of slightly old school. And we're seeing wives, daughters, they're becoming much more interested in real estate as an asset class.
Yeah.
They really want to understand the underlying risks that are being taken.
Okay.
We're seeing a lot of trends towards a digital requirement. So they want to be able to manage their portfolios online. They want to be able to mix what we do with their busy schedules. And I think whether you're a man or a woman, what's being asked of us all is to be much more of everything, right? So traditional roles in the household have massively changed, and we're all expected to do a bit of everything, and we're trying to make that easier for our investors, whether female or male. But we're definitely encouraging more connectivity to the female parts of our clients in terms of, you know, we really want to meet your daughters, we really want to meet your wife. We don't want to just have events and 85% of the room is male, which, you know, 85% of real estate events you go to, 85% of the room is male. And it's just, it's time, right? It's time to change that.
It is, and I think it's also really helpful for those families as well, because one of the things that we often help families with is their succession planning. And actually, you know, as much as everyone can have a business plan, things can happen in families, you know, death, divorce, all of those things, illness. And so it's really important that all key members of the family know what's going on, or can do if they wanted to be, or have trusted people that they can rely on if needed. And also to have succession within families and businesses work well, to engage the younger generation early, and to help, you know, have a family charter, or, you know, particularly at the stage before younger generations perhaps have met their life partners and marry and do all those sorts of things, to have a family charter of where we're going to invest, how we're going to protect our assets, how we're going to deal with that in the event of marriage and divorce and things like that, can be really, really helpful for those clients. So it's really interesting to hear that you, from an investment perspective, are also having those conversations with your clients.
Absolutely, and I think that one of the things that we really hold dear as well is that, you know, I'm not going to say who it is, but, you know, I've got some of my capital with my private bank. You know, every quarter I just get sent these thick wads of information, 4 documents, 35 pages each. And I'm reading this, and I get to the back, and there's a summary, and there's a tiny little bit on what actually is my true performance. It's always very uninspiring, but that's another. So what we're trying to do is create a system that if you want to have a chat with us, that's great, you pick up the phone, but whether you're a mum, a dad, the matriarch, the patriarch of the family, you can log on to our portal and you know exactly where you are. You know how much money you've got invested, what you're earning on a nightly basis, how much you've been paid, what your accrued interest is. And I'm not sending you copious amounts of letters about what fees we're charging you. It's all net, you know where you are. And a lot of our families are saying it's just so refreshing because, you know, it's the only asset class that we have where it's very transparent and very simple, and we're not being bombarded with a load of literature.
Yeah, and it's really helpful as well, isn't it? Because the tech allows you to be really clear about those things, so that actually your interactions that you have with your clients can be really personal, and actually just, I think what high net worth really appreciate is somebody giving them a call to check in how they're doing, and then speak to them on a relationship perspective and give them that sort of 1 minute insight, because yes, they're up to speed on all of the details and the data. You can focus much more on service delivery than sort of the more generic things that I think a lot of platforms are sending all that bump and all the letters out.
Yeah, and I think it's important that investors understand how much work and time goes into building these platforms, because it's a given now that everything that you do, you expect to be digital. But they don't see, you know, the beads of sweat coming off our CTO's head as he's desperately coding. But it's great to be able to pick up the phone to one of our families and say, are you in front of your laptop or your phone? And they say, yeah. So, well, log in. And then we can talk in real time with simple information in front of investors, and you can combine the personal touch with the digital enablement, which, you know, is quite rare.
That really sounds very refreshing.
And it's hard work.
Well, it's lovely to have you here today sharing your thoughts and your insight into your investment platform, your debt platform, and also for us to sort of see how that connects with the private wealth ecosystem. So thank you for sharing your thoughts.
Thanks for having us.